Hi, this is David Duty, and we're now going to look at video number 4, in which we're going to talk about in, at, and out of the money calls and puts. The first screen, as you can see here, the first chart, is Feeder Cattle 2007, and we're going to look at some calls. Now, in the green box here says also you'll hear terms being short a call or long a put. Sounds crazy, but what it means is that if you're short a call, you sold a call. And if you're short a put, you sold a put. And if you're long a call, you bought a call. And if you're long a put, you bought a put. So think of it, like anytime that you buy either a put or a call, you're long. And anytime that you sell either a put or a call, you're short. All right? Now, let's look at this first chart. And let's start down here where the market is currently at. And let's say that we buy a 109 call, all right? That would be at the money. In other words, at the money simply means the strike price is at where the current market closed or very close to where the current market closed. If it's exactly where the current market closed, which usually isn't the case, then it would be at the money. A better term would be near the money. Because it's close to where the market closed. And as you can see, the market closed slightly above 109. You can look down here at the bottom and see that it closed at 109.35. So the strike price of 109, we're going to call it at the money. Actually, it's a little bit below the money. All right. Now, an out of the money call would be this 12. And since it's a call, the market is below the strike price of this call. So this call, this 112 call, is out of the money. In other words, it has no intrinsic or real money value. Now, the one below this one says in the money is a 106 call. Now, that 106 is below where the market is. So if you were to convert this right now, it would have intrinsic value. And the intrinsic value of this would be approximately $1,500. Because it's $1,500 in the money, or in other words, $1,500 worth of real value or intrinsic value. Now, as you can see, the 106 call that is in the money, the cost on that one is $2,137.50. At the money is $1,237.50. Out of the money is $1,000. Now, up here you're going to see the 121 call costs $37.50. All right, it's deep out of the money. And what we mean by deep out of the money is it's so far away from where the current market is that it's very little possibility for the market to increase that much by the time the options expire. If you were to look up here, option expiration is this red line on the right. So the market would have to go up almost $6,000 for this to have any value whatsoever at expiration. Chances of that happening are slim and none. That's why it costs $37.50. You should stay away from purchasing these deep out of the money calls or puts, which we'll look at here in a moment. All right. Let's look at the next chart. Euro dollar. Let's back up a little bit in time. All right. Now you can see. Let's see if that was one day backwards. Right? Now, as you can see, in, at, and out of the money puts, they're exactly the opposite of what a call would be. The market closed right here. You see this little cross. That market closed at 94.60, as you can see, 64, as you can see down here. So this strike price of 94.62 is at or really near the money. It's the closest strike price to where the market closed. So that would be at or near the money. Now, since we're looking at puts, this 94.75 put would be in the money because the market closed above it. So if you were actually short the market from this strike price, currently you would have a little over $300 worth of real money value to it. All right, and the other difference in price at 413 versus 318 is strictly for time value. All right. Now down here, this 94.50 put would be out of the money because it is a put and it is below where the market closed. Down here at the bottom, the deep out of the money is 94.25. Put costs $25. All right. Now, again, I put this up here because it's important for you to know that you're going to hear terms being short a call or long a put. Sounds crazy, but what it means is that if you're short a call, you sold a call, and if you're short a put, you sold a put. If you're long a call, you bought a call. If you're long a put, you bought a put. Just remember, when you buy a call or buy a put, you're long. When you sell a call or sell a put, right, you are short that put or that call. Right? Let's look at the next chart. Let's back it up a little. All right? Here. If you had purchased this call, you would be long a call. So if you had bought or purchased the 60 call, then you would be long a call. If you sold this put down here, you would be short that put. Pretty simple. When you buy, you're long. When you sell, you're short. Let's look at this one. And we'll also back it up. No, we won't. Don't have to. So just remember, you sell a put or a call, you're short. You buy a put or a call, you're long. Right? If you sold this call, you would be short because you sold it. If you bought this put, you would be long this put because you bought it. It's pretty simple. Right? You're long a put or a call when you buy it. You're short a put or a call when you sell it. All right? That's all it is on this short video. Next, we're going to look at video number 5.